If you're self-employed or a small business owner trying to decide which retirement plan is correct for your business, you need to watch this video. Today we're going to go over three popular options: the solo 401k, the SEP IRA, and the SIMPLE IRA. We're going to dive into the pros and cons of each and what sets them apart to help you make an informed decision. And on purpose, I'm excluding the big traditional company 401k plan because this is geared towards small business owners who typically don't have the means or the huge administrative time requirements for dealing with a big corporate plan. So let's dive into what these three plans can do for small business and self-employed individuals. And before we get started, my name is Ryan Knoll. I'm the founder of Nav Wealth Partners, a financial planning firm that helps clients nationwide make more informed financial decisions. So moving into the solo 401k, it's a retirement plan designed specifically for self-employed individuals and business owners with no employees other than their spouse. So some of the key features of the solo 401k you need to be aware of are contributions are split between both employee salary deferrals and employer contributions. For 2025, on the employee side, you can contribute $23,500 and up to 25% of compensation as an employer, as long as you're under the age of 50. For those of you over the age of 50, you can make an additional $7,500 worth of contributions. And if you're between the ages of 60 and 63, you actually have a special provision to contribution to be even more, which is $11,250. And again, that's on top of the $23,500 salary deferral on the employee side. And when these plans are set up properly, you can make non-deductible contributions that can convert to Roth dollars when there's sufficient income. And we're going to cover an example of that in a little bit. So the requirements to set up a solo 401k plan is you must have self-employment income or own a business. There's no full-time employees other than you or your spouse working for the business. The plan must be established by December 31st of the tax year in which employee contributions are made. Employer contributions, you're able to make those contributions until April 15th of the following year. You also need to fill out some plan documentation, which can typically be obtained from a financial institution or a plan provider. And if plan assets are over $250,000, you'll be subject to some additional administrative requirements from the IRS on an annual basis. The pros of a solo 401k plan are the high contribution limits, which allow for significant tax-deferred savings. There's a Roth option available for post-tax contributions, and it's great for individuals with fluctuating incomes as contributions are flexible. Some of the cons of the solo 401k plan is that it's a little bit more complex to set up and has more administrative requirements compared to IRAs. And the annual IRS reporting requirement isn't too tedious or cumbersome, but it's something you need to be aware of because after your plan reaches $250,000 in assets, you will be subject to those additional administrative requirements. And then one aspect of the solo 401k that gives it a leg up on some of the other plans is the ability to make non-deductible contributions and immediately convert those contributions to Roth dollars. This is known as the mega Backdoor Roth. An example of how this works is, let's assume we have a qualifying business owner who makes $150,000 a year. They're under the age of 50 and they contribute $23,500 as an employee contribution, and their employer makes the full 25% contribution on their end, or $37,500. So between the two, they've put in $61,000 total, but you and I know that the upper limit is $70,000 for a solo 401k contribution for anybody under the age of 50. So the business owner in this instance can actually contribute another $9,000 as a non-deductible contribution to the plan and immediately convert it to Roth dollars with no tax implications, and then ultimately take qualified Roth distributions from that contribution in retirement with no tax implications, assuming other requirements are met. And if you're doing it in retirement, typically the main precursor that you need to meet is being over the age of 59 and a half. But that's something to talk with your financial advisor about to make sure you'll qualify for the tax-free distribution in retirement. So next, let's talk a little bit about the SEP IRA. And the SEP IRA is short for Simplified Employee Pension. It's ideal for small business owners and self-employed individuals who want a straightforward plan. Some of the key features of the SEP IRA is that only employer contributions are allowed up to 25% of eligible compensation, and the overall limit is the same as the solo 401k of $70,000. Contributions are tax deductible to the business as well, which is another key feature to this type of plan. Some of the rules business owners need to follow is that the SEP IRA treats the business owner as both the employer and the employee. Contribution limits for the owner are the same as for the employees, up to 25% of the owner's net earnings from self-employment after deducting one half of the self-employment tax, with a maximum cap of $70,000. Contributions must be made at the same percentage of compensation for all eligible employees as the owner. Some of the pros of this plan is that it's easy to set up and maintain. It has high contribution limits, similar to the solo 401k, and contributions are discretionary, so you can adjust based off business performance. So years with excess cash flow, you can contribute a little bit more. Years where cash flow is a little bit leaner, you can actually decrease the contribution percentage and lower the ultimate plan cost. Some of the cons of this type of plan are contributions must be made for all eligible employees, not just the owner. So if owners want to contribute a high percentage of their salary, let's say they want to max it out every year and need to contribute 20% of your salary to do that, they must contribute that same 20% for all employees, which can drive plan costs exorbitantly high. So now that we've talked a little bit about the pros and cons and the features of the SEP IRA, the third retirement plan we're going to talk about is the SIMPLE IRA. And that's short for Savings Incentive Match Plan for Employees. And this plan is tailored for small businesses with less than 100 employees. Some of the key features you need to be aware of is that employees can contribute $16,500 in 2025 with an additional $3,500 catch-up for those over the age of 50. And there's a special catch-up contribution now for people between the ages of 60 and 63, which is $5,250 annually. Employers are required to either match employee contributions up to 3% of salary or contribute 2% of compensation for all eligible employees. The pros of this plan is that it's very easy to administer and less costly than a 401k, and it encourages employee participation in retirement savings. Some of the cons of this plan is that there's lower contribution limits compared to solo 401ks and SEP IRAs, and employer contributions are mandatory, which can be a financial burden for some businesses. So which one of these plans is the best for you? We can't really answer that because there's no one-size-fits-all approach. If you have employees other than your spouse working with you, that eliminates the solo 401k from contention. If you want to contribute more than $25,000 after employee and employer contributions, that will likely eliminate the SIMPLE IRA and potentially the SEP IRA, depending on your income level. Some general rules of thumb that I follow is that if you do not have any employees other than you or your spouse, a solo 401k likely makes the most sense because it's the most flexible of the three plans and provides more benefits from both the employee and the employer side. However, if you have employees and you want to limit how much you must contribute for those employees, a SIMPLE IRA likely makes the most sense. But we're going to walk through a short case study now to see the impact of each type of plan. So now what we're going to do is we're going to walk through a hypothetical example. So let's say that we have a business owner who has sufficient business income to pay herself $175,000 a year. She's 45 years old and she wants to pick the best retirement plan for herself and for her business for the next 20 years before she retires. And to make things easier, we're going to assume static contributions and income for this business owner. I'm also not going to model any other expenses or items that would be pertinent to a financial plan. I simply want to show you the value add that each type of plan will have at her given income level. So moving forward now, we're going to actually go into some financial planning software that I run for a client. So right here, you're going to see that I'm running a example here for the SEP versus Simple versus Solo 401k plan, which is the client who we're working with here. So the first thing I want to do is we want to look at the different cash flows for the plan. So let's start with the Solo 401k. And here with the Solo 401k, what we're going to see is that this business owner, she pays herself $175,000. That's her salary. Her total expenses, which in this case is just taxes, are $38,996. She has planned savings going into this plan for $26,250, which we're going to explain for a little bit. And the one thing that you guys don't see here is the 25% of salary contribution that the employer is making. So in this case, it'd be $43,750. So essentially what we're trying to do is get this business owner to the $70,000 overall limit for the solo 401k for this year. And we're going to continue to do that all throughout the rest of her life. So the first thing I want to click on here is this plan savings tab, because what's interesting here is I'm modeling in each year a $23,500 contribution that is tax deferred rather, for her solo 401k. This goes into her traditional bucket. We know that she's putting in $43,750 from the employer side. So she still has $2,750 that she can make as a non-deductible contribution. So I have this just labeled as going into the Roth Solo 401k, but essentially what's happening here is this $2,750 is going in with after-tax dollars and immediately being converted to a Roth 401k inside of the Solo 401k. That money will grow tax-free, tax-deferred, and it'll be distributed tax-free in retirement. So her overall savings are getting her to that $70,000 level, but we're just getting there in a couple of different ways. The $43,750 contribution from her employer plan, $23,500 from her solo 401k, and then the rest is being made up with this solo 401k Backdoor Roth contribution. So moving forward to the financial plan, going to the solo 401k, what does this mean for expected value to her plan down the line? So I want to show you that we're going to start here with her net worth being roughly worth $2.7 million. And this just assumes that she makes no contributions, doesn't invest any money. Everything that she makes is just sitting as cash. Again, we're throwing out things like expenses and things like that that would be pertinent to a financial plan, but this is just to illustrate the potential impact that she could have should she choose a specific type of plan. And with the solo 401k, the big driver here is the fact that she's putting in $23,500 herself and another $43,750 from the employer. That alone is adding about $2.9 million to her bottom line net worth. And then the non-deductible Roth contribution adds about another $75,000 to that plan by the time she retires at age 65. So we're estimating that by following the solo 401k approach, she's going to add about $3 million to her net worth over time. That's pretty darn good. So let's see what some of the other plans would do for this same individual, and those other plans being the SEP IRA and the SIMPLE IRA. So next we're going to go to the SEP IRA because this one is actually the most interesting, because remember, the SEP IRA is just going to show you employer contribution. So if we go to the SEP IRA, I'm going to update my plan down here. We're going to go back to that same table. So what I want to show you is that we have $175,000. That's the income that she's paying herself. So her total inflows are just all subject to all inflows that are coming in. So for her, it's just $175,000 salary, but her expenses went up. In fact, they went up by about $6,000. Well, if you think about it, the reason they went up is because taxes are higher because she's not deferring as much money via the solo 401k contribution. Because remember, the SEP IRA is just an employer paid plan. So her taxes are higher, but her total outflows are lower because she's maxing out this plan without having to put her own money in. So we don't have to worry about accounting for the dollar for dollar reduction in cash flow that she would have by making this contribution from her salary. So her net cash flow is actually going to go up even though she's paying more in taxes. So her net cash flow increases to about $130,000 a year. So roughly $11,000 a month in after tax cash flow. So what does this mean for her long-term financial plan though? Well, if we go to the SEP IRA with that same chart, and again, I want to show you that we're starting at the same exact dollar value, the same 2.717 million that we were starting with the solo 401k. And if we just make the $43,750 employer contribution, because remember, she's limited to 25% of income, this individual, her bottom line net worth is increased by about 2.1 million. So not nearly as much as the $3 million increase that we're seeing by maxing out a solo 401k, but we're seeing still a pretty significant uplift in portfolio assets of about $2.1 million by contributing to the SEP IRA. The other thing that this does that gives it maybe an advantage over the solo 401k in the interim is that it provides her with more cash flow because she's not making contributions from her salary to that solo 401k. She's actually going to increase her cash flow on a month-to-month basis. So that's the trade-off here is, do we not defer quite as much for retirement if we prioritize cash flow over maximizing retirement value? And that's a conversation you need to have with your financial advisor. So going into the last plan, which is the SIMPLE IRA, we're going to go to that same cash flow approach. And we're going to switch this to SIMPLE IRA, and we're going to go to that same table. So there's a couple of things happening here. So we have the same income and the same total inflows that we had in the previous two examples. Her taxes aren't quite as high as they are with the SEP IRA, but not quite as low as they are with the solo 401k. And that's because her plan savings are only $16,500, meaning she's deferring $16,500 worth of salary here. The other contribution that you're not seeing is a $5,250 contribution, which represents 3% of her income that the employer side contribution is making up for her into the SIMPLE IRA. So her total outflows during the course of the year is closer to $57,000, and her net cash flow after tax and after contributions is about $118,000, so roughly $10,000 a month. So if you look at it, the solo 401k, we deferred the most money, but we had the least amount of cash flow on a yearly basis. The SIMPLE IRA, we have an in-between amount we have the moderate amount rather between cash flow and long-term savings. And then with the SEP IRA, we have the most upfront cash flow because everything is an employer contribution, but we don't have quite as high of an overall return as we would with the solo 401k. So again, we just need to figure out as your financial planner, how do we maximize what you're looking to do? Do we prioritize cash flow or do we prioritize long-term investments? But let's circle back here to the SIMPLE 401k to try to understand what this adds to portfolio value over the life of this client. So going back to the plans, we're going to go to the SIMPLE IRA, clicking into the decision center here. I'm going to toggle this off just to prove to you that we have the same $2.717 million that we started with in the previous two examples. And if we toggle on the simple IRA contributions, this adds an expected $812,000 worth of value to this client down the line. So if you're looking to maximize portfolio value, the simple IRA probably does not make as much sense as one of the other two plans. In fact, the solo 401k is going to maximize value the most. If you're looking to maximize cash flow, the thing you would want to do the most of is in the SEP IRA, because everything's an employer contribution. So you're not going to carve into the income that you're paying yourself from the business every year. But if you kind of want a best of both worlds approach where you have some interim cash flow that isn't as high as it could possibly be, but isn't as low as it should be if you were to choose the solo 401k option, and you still want to invest a little bit of money on both the employer and the employee side, you could do the simple IRA. I would argue it's the least efficient, but it's also because it's the simplest of the plans, and it's designed just to get to some sort of savings in mind for you. You know, just do some sort of savings to you on a monthly, annual basis. That way you're doing something for retirement outside of your business. So there's no one size fits all approach here. And that's really what we're trying to get at, is that there's trade-offs you have to make with each plan, and you have to prioritize what you want to see happen and pick the plan accordingly. And that's something that a financial advisor can help with. So tying this all together, it's important to realize there's no one-size-fits-all approach to the best type of retirement plan for your business. Do you prioritize cash flow? If you do, you should probably think about utilizing the SEP IRA from a personal standpoint. It enhances the amount of cash flow you're taking home from the salary that you are paying yourself from the business. If you want to prioritize lifetime portfolio value or having as much in investable assets in retirement as possible, you would prioritize the solo 401k. If you simply want to get something set up that's easy and you have less than 100 employees, the simple IRA probably makes the most sense. But I realize that it's really not that cut and dry for most individuals. So what we want to understand is, one, more about your business, and two, more about your long-term goals, so we can tie in the best possible plan for you that accounts for portfolio value and cash flow. So if you're sitting here and still thinking like, hey, I still have no idea what the best one is for me, I urge you to follow the link on the screen or in the description below, and we can schedule time to actually go through the options that you have available to you to try to find the best solution for you. Thank you.